It's after 9 o'clock, after hours, late night show. Might turn on my radio DJ voice. Get super tender. Tonight we're going to look into, hot topic, interest rates, obviously. Mike, you can talk about the market. I don't know. Is it me, or does it seem like it's it's as likely as death and taxes that if real estate agents get on Instagram and start talking about mortgage rates in the fives, within 24 hours they're going to be back in the sixes. I swear to God. Do you not know what a jinx is? Do you not know how to just be quiet and let's see what happens for a couple of days? I mean, the second that the average prime offer rate dips below 6, there's 1,000 people on Instagram, realtors on Instagram, and then the perfect game is blown subsequently.
This is true, and this is one of the reasons I didn't say anything this time.
Mhm.
But they did dip. But then we had, the uncontrollable happen, and now we're back above 6, just a smidge. But it does make a huge difference, as everybody knows and everybody feels. So, what are you going to do? You got to be diligent. You got to be on it. And if you're looking to, make a move, then you should have been receiving a call from you or one of our friends and getting locked in and making it happen. But it'll get back down.
So the thing is that we've talked about in the past is like you can't wait to get ready. You got to be ready. And
Yeah.
if you're under contract in process and you have a 30-day window, you can catch one of those dips. It does look like, all jokes aside, that the latest was legit. It was legit and it was here to stay, and we'll see what happens. Now, a lot of people in the mortgage industry, lifers, they don't root for conflict in the world. They don't root for war. But when war breaks out, typically what happens is investors, financial folks, the flight to safety. They go to safe investments because equities, stock markets don't do well during conflict. So they go to treasury bonds. That's where they put all their money. Typically,
Yeah.
when people are putting their money into treasury bonds, the yields go down and rates go down. That did not happen this time, or at least the other factors within this conflict are outweighing the flight to safety. So the other factors in this particular conflict are the implications that it has on oil.
Mhm.
If oil supply chains, distribution, production, whatever is delayed, or if there's problems with that, then the price of oil goes up. Guess what goes up with that? Inflation. Not good for interest rate. War, bad. Inflation, not good for interest rate. So that's why we're not seeing
Yeah.
the bond go down with the conflict.
Hopefully it gets settled in here. But this is why I talk about, like, when people ask, where do you see rates going? Where do you see them going? You have to tell me right now, exactly right now, where it's going to be 3 months from right now. And the answer is always, I have no idea. And if anybody tells you they have any idea, they don't know, because then we have stuff like this happen and it throws it all out of whack, even though we were on a downward trajectory. So you just have to remain on it. And listen, if you're buying a house, you need to be serious about buying a house at the time you're looking, not just like looking and hoping rates go down. You catch it at the right moment. That's not going to work. So getting the house, and then, as long as you can afford it, of course, and you get that house, and, we have the good things happen to us and rates continue down, you're able to maybe catch a refi at a lower rate, soon thereafter. And look, you've already got the house. Now you don't have to fight with everybody after the rates have gone down and everybody's talking about it online. And, there's a million people bidding off, on the same house. So,
Yeah. So the thing with this most recent rate dip though is the reason that was promising, and the reason that if somebody was asking, hey, what's the crystal ball? What do you think? The reason that I would say the rates are trending down are we've had some pretty strong things happen, like the Supreme Court. Supreme Court ruled against the tariff, saying that it was illegal,
yeah,
and something like that, you would expect the 10-year Treasury to skyrocket and rates to skyrocket, and they kind of they weathered that storm, and yeah, the 10-year went from about 4.1, 4.2 down to like 3.9, which was amazing, and that's why we saw rates go from about 6.25 to 5.99, 5.875. But even with this extreme conflict, the 10-year Treasury is still fighting to stay below 4.1. It's about 4.08, 4.07, 4.09 throughout the day. So it didn't jump up. It could have been way worse for what happened.
that's
And
good.
yeah. And so I'm going to do a quick screen share and show this article of when rates were low.
Sharing is caring.
Sharing is caring. So all right, can you see this? You see it moving up and down, Mike?
Yeah.
All right, cool.
You're scrolling like I scroll at nighttime.
So what's driving the mortgage rate drop? So these are some pretty big things. So this is why the mortgage rates are going down. So strategic moves in the bond market. Trump administration, I don't know if people remember this, but Trump and his administration urged Freddie Mac and Fannie Mae to actively purchase mortgage-backed securities in the tune of $200 billion injection to stimulate things. So that was driving it down. Inflation was cooling. There were a couple job reports and labor market reports were showing that that had cooled. So that was so labor market wasn't on fire. All some pretty big. Market movers, some pretty like real things were moving the rates down. It wasn't just a one-off day. So I think when this thing figures itself out, hopefully it's sooner rather than later. Who knows with how long these things go? But if it sorts itself out, I think we'll see rates want to come down, and the market wants rates to come down. So
Right.
I do think that we'll see that as soon as this thing levels off. And just to reiterate, it could have been way worse.
Thank God it's not, because then that would have really put a spook into people. All people want, and I think based on the conversations I have, they just want something that's steady. They want it below 6, first of all, but they want it to be steady, not like this rocky roller coaster. They just want it to be like level. It could be 5.99 forever, but as long as it's 5.9999 forever,
predictable.
Yeah,
level of predictability.
Yeah, it's going to make it that much easier for people to make a decision. They just get very skittish when this is we go 5.99, then we go to 6.1, then we go to 6, and then we go to 6.18, and then back down again. So
well, there's if it's like everybody's looking at it under a microscope. So it's like if you look for something, you're going to find it. So if we're all again, not to beat up on people on Instagram, I was on Instagram today talking about a rate I got somebody, but
good rate. It was a good rate, guys. It's a very good rate, and it was it was a rate that was under 6.
It was under 6, and we can talk about and get into why, because it applies to Baltimore and your market as well. Some zip codes. So we will get into that. I would love to get into that. So yeah, I mean, I think that it just the news cycle, even on a real estate level, like if you're shopping for a mortgage, you're probably seeing a bunch of realtors and lenders talk about stuff all the time, and you're in that echo chamber. So
yeah,
all of us talking about rates. Yeah, it's probably freaking people out. So we should probably all just chill. and just then deliver, like, on a case by case basis. Like, you should check it out. I don't know. You should check into what your rate would look like.
Speaking of that, like what is actually going on in the market? So we had a conversation and we had a team meeting today. It's like, what are you seeing out there? What, because we're all working like kind of like different, pools of people, right? We work different areas of Maryland and Pennsylvania. And it's like, what is going on? Because there's some people that are saying that, you can be extremely competitive with asking for, a lot of seller help and seller credits, or, coming in under the list price. And then me personally, I work with all subsets of buyers and sellers. So everybody from buying investment properties that cost 30 to 50 grand, all the way up to $2 million properties and higher, frankly. This pool of the 300 to about 425. Prior 6 months, you were able to go in, ask for a ton of closing help, and likely get it, which is a really good thing for buyers. That's awesome.
Especially in that price point, honestly.
100%, because those are the people that are like typically first-time home buyers. There are people that have maybe been renting or like, decade-long renters that are looking to finally purchase their first home. And they are now getting squeezed out again because, rates got down a little bit. The weather's warming up, and now you asking for seller help is like almost crazy talk again, because there's been like 5, 6, 7, 8 offers on these properties. What they have really, they're not that good that they need to get all those offers, but there's just so many people that have been waiting and,
We've been talking about this for 3 years, 3 or 4 years, coming on 4 years probably.
Yeah, and it's back though. It's back, like, the
It's
end
a
of last
bottleneck.
year. Yeah, the end of last year,
huge
you could have done
bottleneck.
this. Now it's back, and so
Let me
there's
ask you a
that.
question. Is it back more so because more buyers are in the market, or are there the same amount of buyers? There's still just an overload of buyers. There's just less inventory. Is it a combination? Just your
Both.
opinion.
It's both.
It's both.
But with the weather warming up, I think it's just making people more aggressive. We've had a long winter. Kids haven't had a full day of school since the middle of December, or a full week of school since the middle of December. So, I mean, there's a lot of angst about, getting bigger spots, making a move, and, kind of all these things. This is the realities of it, the day-to-day boots on the ground kind of stuff. Whereas, people are ready to move, and there's just so much pressure, and people are kind of like shell shocked at this because they see the national news prior at the end of last year stating like, yeah, there's a lot of inventory out there and you can go and get seller credits, which, the inventory was up a tiny bit, but now then you could get some seller credits. Now it's just like, forget it. Now you're competing again. You're like giving up the farm. And then on the other end of it, you have people at the move up people. So that's people that have been in the 4 to 5s, $100,000 homes, and then they're moving up to like the 7, 8, 9, $1 million homes. It's a little bit less, but these properties are tending to be a bit more dated. And so this buyer pool is much more picky. Because
so the 400, so the people that are, so this could be a good segue if I'm reading the room. So the buyer pool for the 400 to 500 is pickier. So the people that are moving up,
3 to 450, call it
3 to 450. So they're picky. So then the move ups that need to sell those 3 to 450 are having a little bit of a hard time to sell their departing residents and buy their new.
No, they can sell it super easy, but when they want to go and buy their next one, they're having a hard time finding it because the inventory that is there is typically dated. So these are the properties that our parents have owned for 30 years and that generation. And but that particular homeowner hasn't done enough updates to justify the price for these people to make that move up and spend that amount of money. So they're kind of waiting. And so the ones that
And yeah, and they they don't look. They're boomers,
yeah,
right?
right.
And they, maybe they're not used to negotiating with millennials. Maybe they don't want to negotiate with millennials.
Right.
Maybe that's a
It's
whole nother
true.
show.
It's definitely
But
another show.
we've all seen it, and it's like, there's been a lot of equity. There's been a lot of equity going on, growing in that price point specifically.
Well, think
But
about it. If you're, I'm not trying to cut you off, but like um, these move up buyers, right? Like it takes a lot of money and a lot of saving and a lot of time to get into this move up home. You don't really have a ton, most people don't have a ton left over to get the home that's dated and then make the updates that they really want or to
and
really,
just on a mental from a mental
yeah, it's
standpoint,
exhausting.
it's exhausting to look at an $800,000 home that needs work.
Right.
Like it's a mind F to think. And even like the $1 million price point in some markets,
Yeah,
it's
yeah,
like
for sure.
this is what gets you $1 million. It's tough. But then again, there's people like us, who, families have grown over the last 5 years and you need more space. So that's the price point. It just is what it is. And it can be a tough pill to swallow. I'm going to use all this as a segue, whether or not it works. So sometimes the move up buyer specifically, or the move down buyer, the younger generation that's moving up or the older generation that's downsizing, they all have a hard time conceptualizing selling and then buying. It seems like it's coming up more now than ever, where folks want to go out and find their home, know that they've secured it, go under contract, and then worry about the sale of their home later. Whether it's because of financials or whether it's just because of comfort, that's happening more. Maybe because it's been hard to find a home and you don't know if you're going to go offer on 6 different houses. So I'm not going to sell my house I'm not going to get my house sold, be homeless, and then go find a house. So anyway, for those folks, we have very specific, very helpful programs. We've got buy before you sell programs. We've got bridge loans, and we've got home equity lines for people who intend to sell. So these things are extremely helpful. So the buy before you sell is a guaranteed purchase of your home. It's a non-contingent cash offer to buy your house. All that does for us is it allows us to put a contract in the file that's non-contingent, that allows us to exclude your departing residence payment from your ratios so you can go qualify and be non-contingent when you're going out and buying. So, and then on that program, you have 180 days to get a realtor like Mike to sell your house. So 6 months to get your house sold on the open market. Nobody's in the business in that space in mortgage, that nobody is in the business of wanting to buy people's houses and then have to try and resell them. They want to collect the fee. There's a fee. They want to collect their little fee, their $1,500 fee, $2,000 fee, and then hand the home back over to you and you sell it. And they get to write the mortgage on the buy side.
Yeah.
So that's a good way of excluding the debt. A lot of these move up buyers have equity in their home, and they're like, some of them have tons of income, no debt, and they can qualify for both. So they don't need to buy before you sell, but they still don't want to sell until they've bought, but they want to get that equity out. We've got AI-driven home equity lines where it takes literally 5 minutes, no appraisal, no income, where they do the AI does a credit analysis, analyzes 2 months bank statements, looks at your deposits, does a soft pull on the credit to get your debts, and does an automated valuation model, AVM, to get the value of the home, and bang, it spits out, here's 100 grand if you want it. Here's 150 grand if you want it. Here's 400 grand if you want it. Here's 20,000 if you want it. It just tells you what you can access in literally 5 minutes.
It's my money and I want it now.
Right. I want all of it.
That's great because the anxiety that comes onto people when they feel like they have to sell their house to buy their house and they feel like they might be homeless, that it's a real thing. That's a real thing. And if anybody's watching this and you've gone through this, you definitely have asked your agent or me that question. Like, am I going to be homeless? Are we going to be able to do this? Are we going to be able to time this up? This makes it so much easier when you have something like this and you can utilize it. And it just look, it's one thing less on your plate. Moving in general is a huge deal, and there's a lot that goes into it. So if you can utilize a program like this, it's definitely something you should consider.
Yeah. And it's just about like solutions.
Yeah.
I think lenders want to lend money. Banks want to, like, let's be honest, it's how banks make money. They lend it
Yeah.
and they collect interest on it. So if they're not lending money, they're in trouble. So when we're in a market or we're in a 4-year, 5-year span of, a third of the homes being traded throughout the year, then lenders get creative and they get solutions. So it really is a solutions-based market. It's a needs-based market. People are moving because they have a need more so than they have a want. So it's needs-based. And then there's a lot of sticky situations and problems and tough things. So we have adapted to have solutions to issues. So we're here for the solutions. We're here for it. Mike and I have been doing this for quite some time together now. And look, we're problem solvers. You know what I mean? Like,
listen, man, the crazy stories that I've had lately, I'm all about just trying to find a solution to everybody's problem. Because there's been some wild stuff going on lately, and
I feel like that's like everybody you talk to, and it's just, I guess it's just a matter of like, just, I don't know, it's just a matter of a tight market and a tough market that is just like brings out the wild ones.
Yeah, and just expectations, I guess, because my friend did this, my uncles did this, he said this, she said that. I think it should be done like this. What are they doing? Why are they doing this? It's wild. It's wild stuff. But listen, there's a solution, and it's as long as you have the right intentions, we can definitely get through them all.
Yeah, and one more thing about buying before you sell. You don't have to, like, if you've got $500,000 of equity in your current home and you only need 100,000 of that to put 20% down or less, whatever if you don't need the whole thing to get into the home that you're going to get into, you can get in with the lesser down and then sell your house, and then you can go to your lender. And not many people know this, but you can go to your lender, and oftentimes you can do a principal reduction payment. So you can go to them and say, I am going to apply $400,000 to the principal. So your principal is reduced by that amount. You can also, and this is something to talk about your lender if you're closing on a loan, if this is possible and this applies to you, you can ask your servicer to recast your mortgage, not refinance, recast. So recast. So your loan is based on your term, 360 months, 30 years typically. So it's the loan balance and the 360 months, interest rate, blah, 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 equals your payment. You throw $400,000 at it and don't recast, well, your payment's going to stay the same monthly, but you've knocked down your principals. You pay it off quicker. If you recast, it recalculates that whole equation based on the new loan amount. So the principal and interest is now based on a lower loan amount.
I can't tell you how much I love when I talk to somebody new and we talk about, what they're thinking about, like in terms of like what they can afford, and they throw out the word recast. I'm like, oh, that's music to my ears. You know what we're doing here. You're in the game. You know what to do.
Yeah.
We're in it. We're gonna crush this now because what's up. We're all on the same page. We're speaking the same language. Let's go. I said that I had this same conversation 2 days ago. It was just like, brother, this is awesome. I can't tell you how ahead you are knowing what a recast is because most people don't.
Yeah. Yeah. It's a fine line between knowing enough to be dangerous and knowing too much.
Yeah.
Yeah, there
that's
is
true.
such thing as too much information, and it seems like the folks that do have that too much information, like I mean, I've been in this for 14, I don't know, 14, 15 years. I still learn stuff. So anybody that walks in off the street and is buying their second house in the last 8 years and wants to play expert, that's
Yeah. Oh
crazy
yeah. Oh
talk.
yeah. 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 Yeah.
Those people sometimes become like ultra crazy shoppers too, where it's like they're talking to like 17 lenders and 4 title companies and 6 homeowners insurance companies and two real estate agents, and I don't even need a real estate agent. And
Yeah, I can't believe I don't know how anybody would keep that straight. That's crazy talk.
yeah, I tell people like, look, I mean, cut it off at 3. 3 lenders. Talk to 3 lenders for the first week. Figure out who you like. Narrow it down to 2.
Yeah.
If you like them both, like what do you like? Shopping 5, 6.
It's
You
a
know what I
full-time
would say?
job.
If you look hard enough, here's what you're gonna find. If you are looking at a lender, a lot of lenders are licensed in all states. So you can go online and you can find. If you look hard enough, you'll find a loan officer or a lender who will just lie to you.
Oh,
I hate to say it. I hate to say it.
I had
If you
somebody
look
call me
hard enough,
today. It was spitting straight BS, and I know it was BS because this person has a rep for being a BSer. And I was just like, please don't ever call me.
right? Yeah, I'm doing a refinance of my own home through my company,
Nice.
and holy hell. I've been answering these calls. I'm like, what are you gonna do next month when they stop selling trigger leads? Like, just so the Equifax Change Union,
Yeah.
they can't sell your information anymore when your credit gets pulled. So anybody that's had their credit pulled by car company, credit card, or a mortgage company, they know that all of a sudden they get calls, and it's no coincidence. So I've been getting these calls because I pulled, my credit was pulled by a mortgage company, and I told one guy the other day, I was like, I'm in the industry and I am embarrassed by how many phone calls I have gotten from you people. It is embarrassing. Like, you should be ashamed.
You
And
should have listened to me. You should have recorded all that.
I know, I probably should have.
That
I
would be
mean,
so funny. That's great content. That is
yeah.
hysterical.
Well, I mean, I pulled my credit 2 weeks ago, and I had conversations today. I'm like, what are you gonna do when your company can't give you these triggers anymore, and you can't just
Yeah.
blanket call people, and you have to actually like. Yeah, I mean, I've called triggers in the past at times, and like it's a part of the business, so I'm not knocking it, but I am knocking it. I mean, it's insane. But what?
You should. I'm so upset. I might I might pull my own credit just to see what happens with this. Just start
Yeah, you
recording it.
should do it. Do it before like when does that go into effect? No more
Next year, I think,
trigger
right?
leads. No, it's coming up in like a month. Effective March 5th, tomorrow.
Oh,
Home buyers. All right. You heard it here first. Tomorrow, effective March 5th, 2026, the Home Buyer Privacy Protection Act severely restricts the sale of mortgage trigger leads. Credit bureaus are banned from selling consumer data to third-party lenders upon mortgage credit pull, ending the flood of unsolicited marketing calls and emails, unless the consumer consents to an existing or has an existing relationship. So That's pretty cool. I think it's funny because I think banks like federally chartered banks are exempt from that. They can still buy them and call, which is just like crazy.
Yeah, but they don't. Those mortgage departments, are they even making those calls? They don't.
I guess they don't. I don't know.
Like
They're
Bank of
so
America's not
crusty.
making outbound calls.
No. Who's still using Bank of America for their freaking mortgage? It's
I,
crazy.
crazy people. Um,
I was at a networking thing today, and God bless her, but this lady stood up, and I mean, she had to have been 80, and God bless her. But she worked at one of these big banks, and she was in mortgage, and she probably killed it for 100 years. But like, who's using? I mean, who's going to these crusty old banks
oh, I
and
know.
getting and going
Swindled
through
and
that?
swindled and put through a meat grinder.
Yeah, and every time you call, you go to a 1-800 number, and it's like,
Horrible. And it's like, hello, you've reached Bank of America. Thanks for calling the
mm-hmm,
mortgage department.
mm-hmm.
Please press 1 to talk to Cindy. Please press 2 to talk to Benjamin.
It's Benjamin. Benjamin's outside smoking a cigarette.
Yeah, it's terrible. It's terrible. You can't talk to anybody, especially like when we need docs and stuff, signatures and whatnot. It's like, come on, man.
Benjamin's outside smoking a cigarette like it's 1999 in a button up shirt that's way too big for Benjamin.
And baggy khakis.
Mm-hmm. Baggy pleated khakis to steal Al's. I think I don't know if that's an Al original. You never know with him. You know, he's stealing stuff for left and right from movies, obscure cult classics from his friends. One-liners from this guy, a line from a song.
It's too good. All right. Well, that's probably good for us tonight, but a lot is changing in the market. It's heating up. It's getting a little crazy out there. So
It's heating up.
get
It's
in the
cooling off.
saddle.
It's hot
Get
ice.
in the,
It's like
get
it's
on the
like icy
saddle.
hot.
The floor
It's
is
like icy
lava.
hot.
The floor is lava.
This market is icy hot. It's hot and cold at the same time. So buyer beware. Swim at your own risk. Freaking no lifeguard on duty. Come on.
We're gonna get shacked for the promotions. All right, we'll catch
Yeah.
you on the next one.